So today we're going to be looking at cash flow analysis in industrial engineering. As we know, cash flow refers to the inflow and outflow of cash, and it gives us a statement through which organizations can understand their various incomes and expenses. Today we're going to see how this helps in industrial engineering. So, understanding cash flow, the lifeblood of operations. In industrial engineering, cash flow isn't just about money, it's the operational pulse that dictates an organization's health and ability to sustain and grow. It represents the movement of funds into and out of a business, critical for day to day functioning and long term strategic initiatives. So, as I had mentioned before, this gives us very clear cut information about where the organization is able to bring in money and the various income sources, and even more critical information about the various expenses of the company and the different areas where the company is losing money and an outflow of cash is happening. Why cash flow matters in industrial settings. The first one is operational continuity. It ensures smooth functioning of production lines, timely raw material procurement, and employee salaries. Second one, investment capacity. Adequate cash flow facilities investments in new technologies, machinery upgrades, and R&D. Third one, risk mitigation. A healthy cash reserve acts as a buffer against unforeseen disruptions, market fluctuations, or supply chain issues. Fourth one, strategic growth. Enables expansion into new markets, acquisition of competitors, and overall business scaling. So, due to these four various reasons, cash flow is important in industries. Moving on, the key components of cash flow, that is the inflows and outflows. So when we come to the cash inflows, revenues from sale of goods and services, receipts from debtors, sale of assets or investments, loans or equity financing, government grants or subsidies. Now, looking at the outflow section, we have raw material purchases, operating expenses, which includes wages, utilities, rent, and various other factors. Third one we can see under outflows is capital expenditure, which is the new machinery, facilities, etc., and loan repayment and interest and dividends paid to shareholders. Now, moving on to the tools and techniques for cash flow forecasting. This graph over here represents the various fluctuations, and this graph helps us to forecast the various movements of cash inflows and outflows. As we can see, as the months go by in the year, there is a fluctuation of the amount of income that is coming in and going out. So these give us a good information, and this helps us to forecast the various situations that the organization will be going through based on difference in income and expenditure. Moving on to the first case study, optimizing production for improved cash flow. Now, the first process, as we can see, is a manufacturing plant faced challenges with high inventory costs and inconsistent cash flow. By implementing loan principles, they streamline production processes and reduce lead times. So we have different pointers here. The first one is process mapping. Identified bottlenecks and waste in the current production line. Second is inventory reduction, implemented just in time inventory, significantly cutting holding costs. Third one is production scheduling, optimized schedules to match customer demand more closely, reducing overproduction. Fourth one is supplier negotiation, renegotiated payment terms with suppliers for cash management. The result of this is a 20% increase in cash conversion cycle efficiency and a 15% reduction in operational cost within 6 months. So as we can see here, there is an increase in efficiency and a decrease in the cost of the organization. The second case study, capital investment decisions and their cash impact. An automotive components manufacturer considered investing in a new automated assembly line. A thorough cash flow analysis was crucial to assess its financial viability. So the initial investment was the cost of new machinery is 5 crores. The installation and training was 50 lakhs. The projected annual cash inflows are increased production capacity of rupees 1 crore, reduced labor costs of rupees 80 lakhs, and improved quality, reduced rework, that is 20 lakhs. Now, using techniques like NPV, which is the net present value, and IRR, which is internal rate of return, the analysis showed a positive NPV and an IRR, exceeding the company's hurdle rate, validating the investment. The project demonstrated the importance of considering long term cash flow implications on large capital expenditures. Now, as we move on from these different case studies, let's look at the identifying and mitigating cash flow risks in manufacturing. The industrial operations are prone to various risks that can be severely impacted due to cash flow. Proactive identification and mitigation are essential. Supply chain disruptions, that is to diversify suppliers, maintain strategic safety stock. The second one is economic downturns, to maintain strong cash reserves, explore flexible production models. Third one is the technological obsolescence, invest in R&D, implement phased upgrade cycles. And the fourth one is quality control issues, that is to implement robust quality assurance and invest in preventive maintenance. Now, leveraging cash flow insights for strategic industrial decisions. Now, cash flow analysis is not merely a financial exercise, it's a strategic tool for industrial leaders. Optimize working capital, streamline inventory, manage receivables and payables effectively. Identify growth opportunities, invest in high return projects that promise strong future cash generation. So, as we discussed before about the NPV and IRR, we need to assess very clearly where on which case we have a better return and a better NPV. Based on those, we need to invest the money into those projects and into those cases and into those scenarios which give us maximum money, give us maximum profit, boost our efficiency and productivity, and make our organization improve and reduce its cost. Enhance risk management, build resilience against market volatility and operational challenges. Improve operational efficiency, pinpoint areas for cost reduction and process optimization. So it is very important to reduce costs, and as mentioned before, we need to choose that project which enables us to increase our profit, which enables us to increase our efficiency and also reduce our costs, because the costs have to be cut in order to have a better profit margin and for the industry to make a good amount of margin and become the best in the industry. Now, Q&A and key takeaways, mastering your industrial cash flow. The key takeaways are cash flow is paramount, the lifeblood of industrial operations, impacting everything from daily tasks to strategic growth. Forecasting is crucial. Utilize tools and techniques for accurate predictions to avoid liquidity crisis. Optimize continuously. Implement lean principles and efficient capital allocation for sustained financial health. Number three, mitigate risks. Proactively address supply chain, economic, and operational risks to protect cash flow. It is very important to analyze the risk because in a company setting, risk can come from any angle. So it is very important for analysts to sit and always make sure that the risk can come from any direction and come up with preventive measures in a way that we can block that risk and it doesn't affect the industry. Strategic advantage, leverage cash flow insights for informed decision making and competitive advantages. Your questions are welcome. Please feel free to ask any questions you may have regarding cash flow analysis in industrial engineering. Thank you very much.